Now let us start with some of the major risks, try to understand what are they, and let us start with the credit or default risk. Credit or default risk is a very basic risk for the banking activity, and the commercial bank cannot sustain without lending money. So whenever you are lending, irrespective of the kind of borrower, you are exposed to the credit risk. So it requires a lot of attention, and if you analyze the kind of capital requirements a bank is required to hold, the credit risk is a major risk for which the banks hold capital. So around 80 to 84% of the capital requirement goes towards meeting the credit risk. So basically the credit risk is the potential of a borrower or counterparty failing to meet his obligation. It's basically captures the credit default. So if the borrower fails, there is a credit risk. Now what is counterparty risk? It is very similar to the credit risk, but is mainly used this terminology when we are dealing with the trading transactions. Suppose you have done a deal with some bank, and if the bank fails, if you are doing a trading activity with the bank, and if the bank fails, basically that is basically is a counterparty risk. And then the what are the different kind of credit risks? One, we said it can be a counterparty risk in case of a trading transaction. The banks are exposed, which is internationally active. You are not only exposed to the borrower, but you are also exposed to the international bank and also the country where this bank is located. So that is where it brings in additional risk when you are doing a cross-country transaction. Country risk is basically linked to the the economic status of the country. How economically the strong the country is, how GDP and the kind of things which are related to the health of the country. So basically it tells, because the corporates who are operating there draw their strength from the country rating. So this is where the country risk is comes in. So whereas the sovereign risk is where the non-performance is beyond the control of the borrower. Like the sovereign restrictions, like in the olden days, the Nigerian government saying that nobody can pay their external obligation. So this is a kind of risk, which is again a sort of a credit risk on because the sovereigns has put a restriction. The corporate has the ability to pay, but because of the sovereign embargo on the foreign exchange or payments outside, the customer is not able to pay. This is basically a sovereign risk. Now what is market risk? As the name suggests, the market risk is related to the market movements. So it could be stock price, it could be the interest rate, it could be the exchange rate. So the market risk is also known as the price risk. So mainly the market risk comes basically it should by the name itself, because we mostly do the trading from the trading book assets and liabilities. Should be attracted only in case of a trading book, but not necessarily so, because when you are running a mismatch in your banking book, you are again faces the interest rate, which is basically known as the interest rate in the banking book. So market risk is basically a price risk, which is adverse mark to market risk. So suppose you are holding the bond, 10-year bond 9%, which we discussed earlier, and if the interest rate goes up, when you do a mark to market, you are going to lose some money. So and as per the requirements for the P&L losses in case of a trading book, we have to make a provision. So that can impact your profitability. So the change in the market price, it could be because of the interest rate changes, like we said in case of fixed rate bond, if there is an interest rate movement, the value will change. And it could be equities. Equities, it's the most volatile market. So people trade based on the expectations or future market expectations. So it's the most sensitive to any economic event in the economy. Then commodity and currencies, again it's a volatile. So a change in the commodity price will, if you are holding in the trading portfolio, you need to make a provision for the losses. So are the currencies. Now, next is the forex risk or the exchange risk. When banks, hold positions in currencies, banks are allowed to hold because they have to meet the requirement of the corporates, and many times it is not possible for a corporate for the bank to totally square up their position. When I say square up, not having any open position. If you have purchased say on behalf of one customer $10,000 and you sell it in the market, and at the end of the day you have a almost zero position, that basically is a square position, which is not possible in case of a commercial bank. So banks are allowed, and the management also thinks they can make some profit if the traders are able to foresee the movements of exchange rate. So that is how the banks take some positions in the exchange, and many times they get a make profit out of this exchange dealings also. And then most of the trading instruments needed to be traded in the market. That is the whole purpose of holding them in the trading book. So if you purchase some security, it is important that you keep track of the market and then sell it in the market when it is appropriate and book the profit. But many times, it is not possible to liquidate your assets like bonds. Particular bonds are not tradable in the market. You had seen even the government securities, some of the securities are not tradable. Means there is not much of a liquidity. So if you are not able to sell in the market because of the market liquidity, that is what is known as the market liquidity risk. Now, operational risk is a very important thing because this has of a very immense importance in the recent past, because many banks and financial institutions have lost a lot of money because of the failures in their operations. So basically what the operational risk relates, risk of losses resulting from inadequate or failed internal process, people and systems, or from external events. So anything which operations, wherever you have an external event affecting your operations, so that is a part of the operational risk. So basically the operational system risk comes out of failed, because banking transactions are very process intensive, and it's all people who manage this process. Even the systems are run by the people, and there is a great requirement technology use in the banking operations. So technology risk again is part of your operational risk. So anything other than the ideally earlier anything other than the credit and market risk was categorized as operational risk, but slowly finer definitions of operational risk events have been done. Some of the broader subset of operational risk are fraud risk. There could be an internal fraud, external fraud. It's a model risk is basically when the banks uses some of the statistical models systems to value some of the derivative transactions or measure the credit risk or market risk. So that one of the important function of the risk management is to measure the risk. So there can be some the models which are used to measure this risk, and bank could have underestimated or overestimated this risk. So this basically is the model risk, which can put banks into a lot of issues, particularly if in the derivative transactions, if your bank is using some pricing model and it's underpricing the risk, then probably the bank will end up in making losses. And the compliance risk is basically and regulatory risk. Compliance risk and regulatory risk is almost similar. When you are not complying with your own bank's guidelines, or you are not complying with the regulatory guidelines, the bank is exposed to what is known as regulatory penalties, and there could be some serious issues if you are not compliant with the law. And then technology system risk, this we have seen because bank uses a lot of technology and systems, whether it is for operations or accounting. So there can be some errors which can creep in case of technology, or there's some technology failure can result into the failure in the customer service, or which makes the customer to put in a claim on you. So it can result into loss. Legal risk, definitely banks ultimately get into a lot of contracts, whether on the deposit side or lending side. So many times if the banks are not able to enforce this kind of documents, so they are exposed to the legal risk. Let us see some of the other risks, important risks which exactly cannot be categorized as operational risks, but they are very, very relevant to the banking business. Which one is the strategic risk? Basically, the strategic risk happens when some of the strategies which are formulated by the management do not meet with the desired success and they fail. Like you can talk about takeover of accounts or aggressive pricing of some of the deposits. So that is basically a strategic risk. It's very difficult to define and make the pricing of strategy risk. Second one is the reputation risk. Basically, this comes out of the negative publicity of the bank. If the bank has there is a fraud, or if there is a regulatory action on the bank, so that basically will bring down the reputation of the bank, and which may affect the new deposits or the business opportunities for the bank. Political risk is like since you are part of the system, so any change in the political changes in the country could affect the banking business. So environment risk is again most of your customers need to comply with a lot of environmental requirements. So when you are lending, this is one risk which has attained a very important place for the regulators. So you have to comply yourself, have to comply with the environment risk when you are operating. And natural calamity risk, like it affects any other organization, banking being a part of the economy. Any thing going wrong with the calamities, a poor monsoon, everything, though it is sort of an operational risk, or the bank losing its own fixed assets because of some calamity like earthquake or flooding, it affects the banks. And the indirectly a natural calamity could, though it is a part of operational risk, could increase the credit risk for the bank, because most of the people who are affected by the flood and earthquake may not be able to repay their loans to the bank. Now, interest rate risk. In the market risk, we have seen the price of an bond going up and down depending on the interest rate movement. That basically affects your trading profit. What we are talking here, interest rate risk, is interest rate risk in the banking book. We have seen that the bank accept deposits for different maturities and lend for different maturities. In the process, there are mismatches as far as the assets and liabilities maturities are concerned. And because the interest rate do change, if you have a mismatch in the asset and liability maturity, and or the better word to use is repricing of assets and liabilities. If there is a mismatch in the banking book, bank is exposed to the interest rate risk. Just to give an example, suppose up to 1 year deposits and all the assets which are maturing, you are surplus in the sense you are more assets maturing up to 1 year. And so the maturing assets have to be reinvested at the rate which is prevailing at the end of 1 year. And if the rate of interest goes up, and if you have a positive cash flow, that means more assets maturing up to 1 year, you will be benefited because you can lend or invest this money at a higher rate. So exactly the contrary when you have a negative mismatch, say up to 1 year. And so interest rate movement, one of the first impact of the interest rate movement is it is going to affect your earnings because one of the major component of your bank's earning is the interest rate or the interest rate net interest margin. So because of the interest rate changes, if it is adverse to you, your interest rate income is going to go down, so that will affect your earnings as well. And even if you are in the trading book, if you are holding a fixed interest rate bond, if the rate of interest goes up, probably you will have some mark to market impact, and your earnings, it will impact your earnings. Economic value of equity is something, when you look at the balance sheet, it is all your assets and liabilities, and the balancing part is the capital. So ultimately, when you value all your assets and liabilities, the residual value has to be taken care by the capital. So that is what is known as the equity. So when you revalue the assets for the remaining, because all your assets and liabilities have different maturities. So to arrive at the correct price of the capital, you have to do what is known as a present valuing of all your assets and liabilities, and it can have that is ultimately what is known as economic value of the equity. So the economic value of equity takes considers the value of the assets or the liability till its maturity. So off balance sheet exposure like derivatives. So we have seen that interest rate derivatives, if you have a position in the interest rate derivatives and your view was that the interest rates are going to go down, if it is contrary to your expectation, and if you are sitting on a position in the off balance sheet based on that assumption, so any movement in the interest rate will affect you depending on what is your position. So there are different kind of interest rates. One basically comes out of the gap or mismatch risk. Basically, when you are, the repricing or the maturity of the assets and liabilities differ. Basically, you create what is known as an interest rate gap. This is basically coming out of the mismatch in the maturities of assets and liabilities. And another is the basis risk. Basis risk comes because your assets and liabilities are based on different benchmarks. Suppose internationally some of the developed countries, this issue is not there because all their assets and liabilities are linked to a single benchmark. Suppose if you take LIBOR, most of your assets and liabilities of a multinational bank will be linked to a LIBOR basis. So you always get protection of movement of LIBOR. But in case of most of the Indian banks, the assets and liabilities are linked to a different basis. It's not being done very scientifically. So when you have assets and liabilities which are which change in a different magnitude, the interest rate on these assets and liabilities change in different magnitude, you are exposed to what is known as a basis risk. Now there are yield curve risks. So what is yield curve risk? Yield curve risk happens because the yield curve is basically when you plot a rate of interest versus maturity. Normally, ideally, the longer maturity will have a higher rate of interest. But sometimes, because of various reasons, the interest rate on different maturities change differently. Suppose the 1 year rate can go up by 1%, whereas the 2 year rate can come down by 0.5%. This is very much possible. So this non-parallel movement of interest rates is what is known as a yield curve risk, or it's basically linked to the shape of the yield curve. Whether it is inverted, whether it is steep, or it's flat. Now the embedded option risk is a very much relevant to the Indian scenario, because that most of the banking products in India, whether it is deposits or loan, deposits can be withdrawn prematurely, and the loans can be prepaid prior to maturity. So it can be with some penalty, but whatever it is, but all this, the contracted maturities will not have a relevance because all are subject, have the option of embedded option. It is known as embedded because it is embedded with the product itself. So all your estimations, all your gaps calculations, maturity mismatches can be incorrect because of this embedded option risk. Reinvestment risk, because when you have an asset which is maturing or you have an interest coming from an investment and you require to reinvest, and if the interest rate change at the time of the reinvestment, you are exposed to what is known as a reinvestment risk, because you will not be able to reinvest at the same rate at which the original investment has taken place. Maybe sometimes it is favorable, but many times you may be required to reinvest your cash flows at the lower rate. Now, net interest position risk is because the repricing gaps, whenever we have assets and liabilities grouped in different buckets according to the repricing. And if you have a net surplus, positive or negative position, this is again subject to the interest rate risk, depending on the excess assets, repricing assets over liabilities or excess liabilities over assets. Due to the bank's core activity of accepting deposits and lending for different maturities, and in the process creating the mismatches in maturities, banks are exposed to liquidity risk, whether it is in the banking book or in the trading book. So how do you define a liquidity risk? Liquidity risk is, when you are going out of cash when it is most required. That's the very simple way of understanding liquidity risk. And you need cash, you don't have it. Or you need cash, it is coming at a cost which you cannot afford. And inability to meet cash outflows obligation at a reasonable rate. That is how we explain the liquidity risk. And in extreme cases, you are not able to fund the liquidity gap resulting into default. That exactly was one of the reasons when this global crisis happened in 2008. The main reason was the liquidity risk. A lot of banks were not able to meet the requirements, the liquidity requirements, because suddenly the value of the assets which were used for repoing went down. Now, what are the different kinds of liquidity risks? First one, we can categorize liquidity risk into three. One is the funding risk. This happens when the net outflows due to unanticipated withdrawals, non-renewal of maturity deposits. You know that whenever all your deposits are having an embedded option, any customer can come in and withdraw the deposits. So though you have as per the maturity bucket, you have a comfortable position, but because of the withdrawal of the deposits, or your ability not getting the deposit rolled over, you have this what is known as a funding risk. Now that time risk comes out of non-realization of your assets. So you have some loans which are maturing, say up to 1 year bucket, and most of them have become NPAs and the repayments have deferred and they are not realized. So this is non-receipt of expected cash flows inflows is termed as time risk. And call risk basically comes out of banks do issue a lot of guarantees, and they do a lot of contingent takeover, some contingent liabilities, and this non-fund based liabilities can sometimes get converted into fund based liabilities, and the banks are required to fund them. So this is something a call risk. A call risk is because suppose a guarantee is invoked, basically the guy is calling, or the unutilized limits or a kind of committed lines of credit. So this basically the call risk. Now let us summarize what we have learned so far by taking some questions. Bank normally undertakes trading activity from Assets in the banking book, this is not correct because we have seen that the banking book assets are basically the core activity and they are the one which are not traded. Assets in the trading book is the correct answer. From both banking and trading book, not correct. Banks do not trade in any asset. This also is not correct because most of the banks do actively trade in securities, equities and foreign currency. Yield curve risk is due to fall in the yield on the loan assets. This is not correct. Non-parallel movement in interest rates. This is what you have seen is the yield curve risk. This is the correct answer. Parallel movement in interest rates. In fact, if there is a parallel movement in the interest rates, there is no yield risk. So this is not correct. Change in the exchange rate, because when we talk about the yield curve risk, we are talking about the interest rate. So the exchange rate, change in the exchange rate is not the correct answer. Now, due to a wrong data entry by a data entry operator, bank has lost 1 lakh rupees. What kind of risk is this? We have seen that the operational risk is the one which is on account of the failed systems, process and people. So this is basically an data entry error which is made by computer operators. So basically the correct answer here is operational risk. Now about the mismatch. Bank has a huge mismatch, positive, that is more assets are maturing. That means the bank will have more cash flow in up to 1 year maturity bucket, and the interest rates are expected to fall down sharply. So when you have a large cash flow coming at the end of 1 year, and if the interest rate going to fall, the excess whatever cash you get at the end of 1 year needs to be invested at the new rates, and if the new rates are expected to go down, bank is going to lose some interest income. So the B, interest income will go down, is the correct answer. That is the end of the session. Thank you.